Welcome back, everyone. Next, we have Caledonia Mining Corporation. It trades on the New York Stock Exchange American under the symbol CMCL and is a Zimbabwean-focused exploration, development, and mining corporation. Happy to welcome its CEO today, Mark Learmonth. Nice to see you, Mark.
Hi, nice to see you.
All right.
Should we start? Okay, well, just by way of introduction, as you've heard, we're a long-established Zimbabwean gold producer. And as I'll outline to you, we've got a very clear and quite exciting growth strategy based in Zimbabwe, which should see us take production from current level of about 80,000 ounces up to 250,000 ounces over the course of the next 5 years or so. So a really extraordinary rate of growth for a small gold producer. Here's the normal disclaimer and forward-looking statement. So as I said, we're an established Zimbabwean gold producer with a clear development strategy. The main asset we have at the moment is the Blanket gold mine, which is in the south of the country, and that's been operating pretty much uninterrupted since 1907. So it's got nearly 120 years of production. So I'll come back to that in a moment. Then over the course of the last few years, we've acquired some other assets, development assets and exploration assets, which lays the foundations for quite an exciting growth trajectory, which for a smallish gold company is actually quite exciting. Very few people in our sector have this growth trajectory. We've got a clear track record of commitment to return value to shareholders by way of dividend. We pay a quarterly dividend. I think we've paid about 52, maybe 53 quarterly dividends since 2012. Currently, the dividend is running at 14 US cents per share per quarter. So that's 56 cents for the year. Share price is currently about $14, so it puts us on a yield of sort of 4% or so. And then it goes without saying, Zimbabwe, we can talk about Zimbabwe later. People are very welcome to ask questions about Zimbabwe. But we are a very major contributor to the Zimbabwean economy in terms of employment and tax payments. And hence, we're a very big deal in Zimbabwe, and government is very keen on what we're doing. So just the portfolio, the production asset is Blanket Mine. We've effectively built a new mine over the course of the last 7 years. We've effectively built a new mine underneath the old mine. I'll show you a bit more about that in a moment. This year we'll produce anything between 74 and 78,000 ounces. That's an on-mine cost of $870 to $970 an ounce. It's fair to say that over the past 5 years or so, having been focused on a very substantial capital project, we may have taken our eye a bit off cost control, so I'm confident that over the next 2 years, we should be able to get those on-mine costs down by at least $100 an ounce. And it's fair to say that over the course of the last year or so, we've restarted deep-level exploration at Blanket. We recently announced a very substantial resource upgrade, and we now have a 10-year life of mine based on reserves, which is extraordinarily long for an underground gold mine of our nature, and a life of mine plan going out to 2041. So that's Blanket Mine, which I'll talk about in a moment. Development project is Bilboes, which we acquired in January 23 for $65 million. In a summary, it is big and it's high grade. So it's over nearly 2.5 million ounces at a grade of 2.3 grams a ton, open pittable. Now, typically most new open pittable gold mines in Africa are coming in at less than 1 gram a ton, so it's very high grade. We've just published a PEA, a preliminary economic analysis of that, which shows a production rate of about 1.5 million ounces over a 10-year life of mine. So that's Bilboes, and that's our immediate focus. In terms of pre-development, Maligreen is a relatively small asset that we bought in 2021. It had nearly 1 million ounces of inferred. We've upgraded that, but frankly, Maligreen, nothing wrong with Maligreen, but it's been overtaken by the fourth asset, which is Motapa, which we acquired in November 2022. And that is a very large scale exploration project immediately adjacent to Bilboes. And we believe in due course that could be at least as big and better, so bigger in terms of more ounces and better in terms of a higher grade than Bilboes. And so Bilboes plus Motapa, we believe, could be a tier 1 gold resource. We've come some way. We've owned this business. We've owned a blanket since 2006, when we bought it off Kinross for about $4 million. And at the moment, we're now making about $4 million every 2 weeks. So it's been a very rewarding asset for us. But we've evolved the business quite significantly over the last 7 or 8 years or so. And it's fair to say, for those of you not familiar with the gold mining industry, gold mining moves at a much slower pace than, say, tech or pharma. So the rate of growth, if you're trying to compare it to other industries, may seem slow, but for the gold sector, it is actually pretty good. We've moved from being, in 2015, one producing asset, the Blanket gold mine, producing just over 40,000 ounces and about 1 million ounces of resources. We've moved through 2021, where we effectively commissioned the new mine underneath the old mine, increased production to 67,000 ounces, made the first acquisition of Maligreen, and increased our resource base from 1 million ounces to 1.5 million ounces. 2022, we agreed the terms of the acquisition of Bilboes. We acquired Motapa. We had record gold production of Blanket of nearly 81,000 ounces. And also we commissioned a 12 megawatt solar plant at Blanket, which provides about a fifth of our average daily usage. And then by 2023, we'd completed the acquisition of Bilboes. We'd restarted exploration at Blanket Mine, and we'd increased our M&I, mineral resources, to about 4 million ounces. Including inferred, we've got about 6 million ounces. So we're relatively big in terms of our resource endowment. Let's just focus on Blanket Mine, which is the cash generative core of the business, which we've owned since 2006. And what we've done is over the course since February 2015, we've sunk a new shaft, a 6-meter diameter, 4-compartment shaft. It goes down from surface in a single drop to 1,200 meters below surface, so that's about 4,000 feet. That shaft itself cost about $70 million, which we funded completely from internal cash flows. And that's allowed us to increase our production guidance from the run rate of about 40,000 ounces before we started that central shaft to a sustainable production rate of, I'd say, sort of 75,000 ounces. It will fluctuate from year to year, depending on the grade. So anything between 74 and 78,000 ounces. As I've said, at an on-mine cost of, say, approximately $900 an ounce. Though, as I mentioned, I think we should be able to get that down by $100 an ounce by realising efficiencies in our electricity consumption and also more efficient use of labour. And we've resumed exploration, so we've substantially increased and extended the life of mine, which means that the cash we generate from Blanket will continue for longer. Here what you see is a long section of the mining footprint. So that's about 3 kilometres from left to right. And we exploit about 7 or 8 steeply dipping discrete ore bodies, which go down from surface way below 1,200 metres. We've been drilling down to 1,500 metres, and we see no signs that these ore bodies finish. The infrastructure that was in place when we bought the mine from Kinross is the stuff in sort of darker green. So that was really focused around a shaft towards the right-hand side of the property called the number 4 shaft, from which we have development in 3 directions, on 3 levels. And you can see that the very dark areas, the black areas, those are areas that have now been mined out. And as I mentioned, this mine's been running since 1907, and so it's not unreasonable that we were beginning to run out of material. And so, frankly, we had no choice. Early 2015, we had to sink this central shaft down in the middle of the mining area, down to 1,200 meters, with horizontal development on 3 levels in both directions, both to north and south. And that allows us to access deeper level material and also gave us the ability to do deeper level exploration. So effectively, as I mentioned earlier, what we've done is we've built a completely new mine underneath the old mine. Got a mine life out to 2041, although we're very comfortable that actually we can extend that mine life further, both by going deeper, and also something that's becoming increasingly apparent to us is by extending the mine laterally. So we have about another 1.5 kilometres on the left-hand side of this cross-section, that's towards the north, and another 1 kilometre or so on the right-hand side to the south, which have old workings. I mean, they have been worked. Gold has been extracted from them. It's just that for various reasons, the mine consolidated its footprint and went deeper. And now we believe that actually we can expand that footprint and look at the lateral extensions. So that's the Blanket Mine. Just a word, I've mentioned exploration. We drilled about 13,000 meters in 2023. Initially, we were just looking to improve the confidence level of the pre-existing inferred resource, which is the lowest level of resource categorization. But actually, we're very pleased that about 60%, 60 to 70% of every hole that we drilled came back better in terms of width and grade. And so, as well as moving resource from inferred to measured and indicated, we also had a very substantial increase in the M&I and inferred resources. So there's a lot of information in that table, but effectively we doubled the mineral reserves by 100%. We doubled it, and we also had about 60% increase in the M&I resource base. So a very pleasing outcome to exploration. The discovery cost for the new ore was about $4 an ounce. So if we're selling gold at the moment for $2,600 an ounce, we found ounces at a cost of about $4 an ounce. Just a word on solar. The only really significant operating challenge that we face in Zimbabwe is unavailability of power. Zimbabwe just doesn't produce enough power. We've had that problem for years. We have been running the mine using a combination of grid power and diesel generators. Diesel generators were getting quite expensive, so we decided to put in place a solar plant. We commissioned that in 2022. It cost about $14 million. The bulk of that we raised through an ATM in New York, which raised $12 million. And that's operated very well. It's operated slightly better than planned. It produces about a fifth of our average daily use. It's got a substantial cost benefit. And actually, we're now in the process of actually exploring a second phase to further benefit from that cheaper power. And also, it has a very considerable benefit in terms of our ESG compliance, reducing our greenhouse gas emissions. And let's just turn to the development and exploration projects, because that is really where the excitement comes from in our sort of further development. The core of this is Bilboes. As I mentioned, it's 100% owned. It's fully permitted. It's a large, high-scale, high-grade, open-pittable operation. It has about 2.5 million ounces at a grade of about 2.3 grams a ton. And we've got a PEA that we published with a production of about 1.5 million ounces over 10 years. I've got to say it's slightly more in the first 4 or 5 years, closer to 200,000, and slightly lower in the last sort of 6 years. At this gold price, it's got a payback period of about 1.9 years. That's a gold price of 1884. It's got a payback of less than 2 years. If you were to use the current spot price, that payback comes down to about 1.5 years. And it's got an all-in sustaining cost of just under $1,000 an ounce. So again, just doing some simple maths, you can see at the prevailing gold price, this mine will be producing cash flow of about nearly $250 million a year for a capital cost of just over $300 million. We've got some NPVs in the PEA. So if you discount the cash flows from the project at a discount rate of 10%, which is relatively high, and using the 3-year trailing gold price of 1884, it's got an NPV of about $300 million, which compares to our current market cap of $250 million. Clearly, at the higher gold price, if you were to use a gold price of, say, 2,400 and a lower discount rate of, say, 7.5%, that gets up towards $1 billion. So there is very considerable upside in terms of value accretion for Caledonia arising from this project. So this is really a very exciting growth project for us. Motapa is a project I just mentioned. We bought that last year for about $8.25 million. It is immediately adjacent to Bilboes. Previously, both Motapa and Bilboes were operated as a combined entity by NYSE American before they withdrew from Zimbabwe in the previous century. And as they withdrew, unfortunately, it became sort of the two halves became disconnected. We're very pleased to put those back together again. It's a big area, 2,200 hectares, or about 9.5 square miles. We've just started exploration in the second quarter of this year, and that program is just finishing. So we expect to produce some preliminary results from that towards the end of the year. But to explore this project fully will probably take about 3 years or so. So it will, in due course, become an add-on to Bilboes when that's up and running. But as I say, we believe that based on the old information we've seen, this could be every bit as big and attractive, if not better, than Bilboes. And then sadly, there's Maligreen, which is the first thing we bought, $4 million, nothing wrong with it, nice little asset, but frankly, that's now been overtaken by events, and we'll keep that on the back burner, whilst we focus our efforts on improving the performance of Blanket and bringing Bilboes into production. Clearly, operating in a country as challenging as economically challenged as Zimbabwe, with its with its governance issues, we need to adhere to the high standards. We are NYSE listed, we're SEC compliant, we comply with the highest levels of corporate governance and ethics. We also comply with the highest level of environmental standards. So we've just completed, or we're just in the process of completing, the construction of a new tailings facility, which complies fully with GISTM tailings requirements. And we also have local ownership in the operating mine. So the workers own 10% of the mine, the community owns 10%, and the government owns 16%. And that has been very important to us, because that means that there's complete alignment of interests. If the mine does well, everybody does well. If the mine struggles, everybody struggles. And that cuts through a lot of the sort of social issues and the community relation issues that so many mining companies face in operating in frontier jurisdictions. So we're very pleased with that. So I think really, in terms of outlook, we're going to continue to produce at about 75,000 ounces at Blanket. We're going to complete a feasibility study at Bilboes in the first quarter of next year and advance towards production as quickly as we can. We're investing in the business not just to achieve growth. We only want to achieve growth by delivering a higher NPV per share, and in due course that converting through into an increase in dividends. We're not interested in doubling our gold production or tripling our gold production, doubling or tripling the number of shares in issue, and effectively going through an awful lot of work to actually go nowhere. And our strategy is to become a multi-asset Zimbabwe-focused gold producer. And really the model for our business is, so if you're in the gold space, you would have seen what's happened recently with a company called Centamin, which developed a gold mine in Egypt. They're now producing about just under 500,000 ounces. And when they started, Egypt was an unloved, overlooked jurisdiction. And just simply by the force of the size of the asset they've generated, they made it investable. And Centamin has just been taken over by AngloGold for about $2.5 billion. So that's very much the model that we propose, that we're aiming to follow in Zimbabwe. So I've gone through that quite quickly. We do have time for questions if anybody has any.
All right, Mark, great job. We do have some questions for you. We want to start with Pierce asks about some geopolitical risks. Do you see any in Zimbabwe, or are there any other areas you're in?
No, we're only in Zimbabwe, and I've got to say, in terms of geopolitical risk, Zimbabwe is becoming very much less risky than many other jurisdictions. So just looking in Africa, our neighbour South Africa is quite a volatile, difficult jurisdiction. And we certainly wouldn't look at any operations in South Africa, which is still remains an investment destination that many people consider. Further north, I mean, there's a long way further north. Africa is huge, so many thousands of miles further north. When you get into the Sahel, which is immediately below the Sahara Desert, and into the west, there's a high degree of insurgency with Islamic terrorists. That doesn't extend anywhere near close to where we are. So we think from a geopolitical perspective, Zimbabwe is actually becoming relatively much less risky very quickly.
And Finn wants to know, how has your production costs changed over the past few years?
Our production costs have gone up quite considerably. partly because of inflationary pressure on our electricity. A high proportion of our electricity was coming from diesel, and clearly at the higher diesel price, that flowed through. We can now reduce that we're now beginning to reduce that by supplementing or replacing some of the diesel with solar power, but we can be much more efficient in our use of electricity. We can be much cleverer in that respect. And also we've seen a significant increase in our labour cost, and that's largely because of headcount. And again, there's a lot we can do to use our labour more efficiently. We're currently coming to the end of a process of reducing our headcount at the mine by about 5%, and that's the expensive 5%. So I am comfortable that actually we can get our on-mine costs down to, I'd like to think about $800, maybe a bit lower, which is very, very competitive.
And Bryson asks, when you look at acquisitions, are you solely looking for projects that need a partner, or do you also get involved with royalty deals?
No, we're not. Well, put it this way: we're not looking at any further acquisitions. I think if we were to make any further acquisitions, I think we would be guilty of overtrading. Our plate is full now. Okay, with what we've got on hand, and we are intending to fund the development of Bilboes primarily using limited recourse project finance from an African development finance institution, something like a Frexim or the African Finance Corporation. There may be a modest royalty, but we will consider the funding package with a view to coming up with a package that maximises Caledonia's NPV per share. So that really comes down to minimising equity dilution. So at this stage, we're working very actively on the funding structures, but we're very clear we're in this business to increase our NPV per share and increase value for shareholders. At this stage, we don't think we will need a partner to bring Bilboes into production. At this stage, we don't believe that's going to be necessary.
And with that said, Memphis asks, what have you seen from a production standpoint as far as percentage growth, and do you see that continuing?
No, well, as I say, we've increased production from about 40,000 ounces in 2015 to currently sort of 75 to 80,000 ounces. Blanket at this stage will probably stay at 80,000 ounces for the foreseeable future. Maybe depending on the exploration success, which that exploration is still ongoing, we may be able to get Blanket up from 80 to maybe 100,000 ounces, but that's still very much work in progress. But the growth will come from Bilboes. That will be adding an extra, just on average, an extra 150,000 ounces a year. So that's a very considerable step up in the rate of production, certainly for a gold mine.
A question from Larry. Larry says, when you say that all ownership is aligned with government, etc., is this ownership in the public company or on each individual project?
It's a very good question. It's a very good question. At the moment, the local ownership is focused on the producing asset, Blanket Mine. Okay, and that's been in place for many years. It's been in place since 2012. There may be a discussion to move the government up from a shareholding in Blanket Mine to a shareholding in the top company. There could potentially be a discussion to move the workers and the community up, but there's also very good merits in keeping the workers and the community focused on the mine in their neighbourhood, which then means they've got a much more direct participation in what's happening in their back garden, rather than moving them up to a more sort of less tangible, amorphous top company level. So I think that's a conversation that's actually being played out at the moment. So at the moment, everybody's in the operating company. I think in due course, the government will flip up to the top level. Whether we move the workers and the community to the top level is a bit of a moot point. There's benefits either way. But I would just reinforce the point. Having the workers and the community directly participating in the producing mine means we don't get the sort of nonsense that you get certainly in other African countries, with sort of local communities blocking roads and sort of very extreme militancy with workers. We just don't experience that, and it's a very, very powerful sort of advantage that we have in country.
And Michael asks, do you have any practices in place to protect and restore nearby habitats if needed?
Well, it's an underground mine, so other than a very small mine footprint, we don't dig big holes, and we don't currently dig big holes and damage any habitat. Clearly, if you were to look at a Google Earth picture of the proposed site for Bilboes mining, you will find that it is effectively very low grade semi-desert with very little there at this stage, and there's nothing in the way of significant human habitation or anything else there. It's pretty much empty. I mean, that's one of the advantages, I guess, of Zimbabwe's dire economic situation is there's not much there, frankly.
And would you diversify out of Zimbabwe?
At this stage, no. We believe that Zimbabwe is very prospective for gold. One of the most prospective areas you can now find. It's prospective for gold simply because so little activity has taken place there over the last 60 years. It's where we have a unique ability to operate. Nobody else can operate there in quite the way that we can, and that just comes down to our expertise that we've gained over the last nearly 20 years or so. And assets are cheap. I mean, buying the Bilboes asset, 3 million ounces, 2.5 million inferred, and 2.5 million M&I plus 500,000 inferred for $65 million. That's a purchase price of $20 an ounce. That is outstandingly low for an asset of that quality, and we certainly wouldn't get that price anywhere else in the world. So, as I say, we're focused currently on Zimbabwe. We have no intentions of looking anywhere else at this stage.
And how are you planning on funding the Bilboes project?
As I outlined earlier, the bulk of the funding we expect to come through a DFI, a development finance institution focused on Africa. We've engaged them already. We're continuing to engage with them. We believe that will provide when I say substantial proportion of funding, I mean over 50% of the funding requirement. We'll make a modest contribution ourselves through our internal cash flows, and then we'll be looking at minimizing equity and maybe looking at a small royalty. But as I say, our funding structure is focused on minimizing dilution and maximizing our company's NPV per share, which should then flow through into a higher share price and elevate and higher dividend distributions.
Well, thank you so much, Mark. Do you have any closing remarks for our viewers today?
Yeah, I think we provide a unique combination in the gold space of yield. I mean, we pay a yield of about 4% with growth. I think you will struggle to find in gold somewhere that gives you that combination of yield and growth with exposure to the gold industry, to the gold price. And Zimbabwe is overlooked, but is substantially easier country to operate in than many other jurisdictions. And it's sort of people misunderstand and misprice the risk.
Sounds fascinating. Well, thank you so much for this very interesting presentation, and we would love to follow along with your journey. So please come back on the conference.
Good. Thank you very much. Thank you.
All right. Have a great day. All right, everyone. We'll be right back with our next presenter.